On the 10th of December, 2008, the most trusted man on Wall Street called his two sons into his apartment. He told them the company had had a very good year and that he wanted to pay out the bonuses early. Then he told them the truth. The whole thing, the returns, the statements, the 17 years of steady profit, was, in his words, one big lie. His name was Bernie Madoff. On paper, he had $65 billion of other people's money. In reality, most of it had never existed at all. For decades, thousands of intelligent, careful people handed him their savings, and nobody checked the math. One man did. He worked it out with a calculator, and for 9 years, nobody would listen. But the aftermath isn't the interesting part. The machine underneath is, and once you've seen how it works, you'll spot the next one coming. This is exactly how the trick worked. To understand the con, you have to understand that Bernie Madoff was not a nobody in a back room. In 1960, he founded a real firm, Bernard the 50th, Madoff Investment Securities, with $5,000 he'd saved installing sprinklers and working as a lifeguard. And the firm was good, legitimately good. Madoff was an early believer in trading stocks through computers instead of shouting on a floor, and that bet made him rich the honest way. By 2008, his market-making business was the 6th largest on Wall Street. He had, at one point, been the chairman of the Nasdaq stock market itself. Think about what that means. This was not a man in a cheap suit promising to double your money by Friday. This was the establishment. He advised regulators, he sat on committees. When Bernie Madoff told you your money was safe, you were being reassured by the person other people called to ask if their money was safe. The family picture completed the costume. His brother was the firm's chief compliance officer. His sons ran the legitimate trading floor. His niece was one of its rules lawyers. His wife had kept the books in the early days. To clients, it looked like a dynasty, money watched over by blood. What it actually meant, investigators later concluded, was that the two Madoff businesses could share one building and never truly meet. The real firm upstairs, in the light, and the other one behind the frosted door, on the 17th floor. But underneath the real company, on a separate floor, there was a second business, a private investment service, invitation only. And that one, the one everybody wanted into, was the lie. Here is what Madoff sold, and here is the first thing that should have been impossible. He promised returns of around 10 to 12% a year, not spectacular, deliberately not spectacular, but every single year. In good markets, in bad markets, in crashes. The real market looks like this. It panics, it gets euphoric, it loses a third of its value and takes years to recover. Madoff's line did none of that. Year after year, his clients' statements went up by almost exactly the same gentle amount, a near-perfect staircase in a world of earthquakes. Most frauds at least fake a bad month now and then. He never bothered. To an ordinary investor, that smoothness felt like safety. That was the seduction. To anyone who actually understood markets, that smoothness was the single most alarming thing about him, because returns that never ever blink are not a sign of genius. They're a sign that someone is drawing the line by hand, which, it turned out, was exactly what was happening. So let's do the part nobody else shows you, the actual machine. A Ponzi scheme has exactly one moving part, and once you see it, you can never unsee it in any other scam. A new investor gives Madoff $100 to invest. In a real fund, that $100 gets bought into stocks and bonds, but the money doesn't go into markets. It slides into a plain bank account, a real one at Chase. That's it, he didn't invest it. Investigators later found the client money sat in an ordinary bank account, and Madoff simply withdrew from it whenever someone asked for their money back. The most sophisticated fund on Wall Street ran on a checking account. Meanwhile, on the statement, the thing the client actually receives in the mail, a staff member picks a stock that already went up, pretends the client owned it, and writes down a tidy profit. The gains were chosen after the fact, from a newspaper. It is genuinely easier to win when you place your bets on yesterday's race, and the paperwork was a full theater production. On the 17th floor, staff didn't just write the numbers, they manufactured the props. Fake trade confirmations, fake account statements, thousands of pages a month, on the right paper, in the right fonts, mailed at the right speed. Court testimony later described the team backfilling entire years of trading history whenever an auditor asked, always using real prices from the actual past, so every line reconciled against the newspaper archive, and even working to make freshly printed documents look convincingly old. It was, in a sense, the hardest working back office on Wall Street. Everyone employed by the lie was producing something, just never returns. Now here's the only trick in the entire building. When an old investor wants their money back, Madoff pays them, using the new investor's cash. Person two's savings become person one's profit. No stocks, no strategy, just a bucket, with new money pouring in the top and old money leaking out the side. As long as more money comes in than goes out, the bucket never runs dry, and every statement looks true. The scheme doesn't need to make a single good trade, it only needs the line of new people to never stop. Which means a Ponzi isn't really an investment fraud at all, it's a countdown, and Madoff kept his running for the better part of 2 decades. He said it started in the early 1990s. One of his own traders later testified in court that they'd been faking records since the 1970s. We may never know the true start date. We know how it ended. Of course, I put your money in a bank account and lie to you is a hard sell. So Madoff needed a story, a strategy sophisticated enough that asking too many questions felt stupid. The one he chose was called a split strike conversion. Buy a basket of big stocks, then use options as a kind of insurance to smooth out the bumps. In principle, a real technique, in Madoff's hands, a costume. Because here is the problem, and it's the kind of problem that doesn't require you to trust anyone's opinion. The options Madoff claimed to be trading, to protect all those billions, trade in a real, public market of limited size. When you added up the trades he said he was making, the number was larger than the entire market for those options. Every contract bought and sold by everyone on Earth that day, and Madoff alone claimed to have traded more than all of it. That's not a suspicious return, that's a physical impossibility. It's claiming to have poured more water out of a glass than the glass could ever hold. The lie wasn't hidden in fine print, it was sitting in arithmetic that anyone could check. So why, for years, did nobody check? Actually, one person did. His name was Harry Markopoulos. And he wasn't a regulator or a journalist, he was a numbers guy at a rival firm, asked by his bosses in 1999 to copy Madoff's magic returns. He couldn't. Not because he wasn't good enough, because the numbers didn't reconcile with reality. He said it took him about 4 hours to become certain it was a fraud. The impossible options volume, the returns that never dipped. A single accountant working out of a strip mall, auditing billions. Every red flag pointed the same way. So in 2000, he took it to the Securities and Exchange Commission, the regulator whose entire job is catching exactly this, and then again in 2001. And again, most famously, in 2005, in a memo he titled, "With no room for confusion, the world's largest hedge fund is a fraud. 30 separate warning signs, laid out in order. 2 of the 30 give you the flavor. Red flag. The strategy was mathematically incapable of the returns. The options market wasn't big enough, as we saw. Red flag. Across more than 14 years of monthly statements, Madoff reported just 7 losing months, a hit rate that wouldn't make him the best manager alive so much as a statistical event the industry has never once produced. The memo didn't ask the SEC to trust Harry's opinion. It asked them to check 14 pages of arithmetic. They did essentially nothing. The regulator looked, asked a few questions, and moved on. The agency whose entire job is catching this looked at Harry's math 3 times over 9 years, and each time decided it could wait. Markopoulos later said he spent years afraid, genuinely afraid, that Madoff or his powerful clients would find out he was the one asking. He was carrying the answer to the largest fraud in history in a folder, and the people paid to care wouldn't take it out of his hands. Which raises the harder question, why didn't the victims, thousands of them, many of them sophisticated, see it themselves? Because Madoff built the one machine stronger than suspicion, exclusivity. He didn't beg people to invest, he turned them away. You didn't invest with Madoff, you got accepted. Getting into his fund felt like being let into a private club. Country clubs, charities, whole communities passed the invitation around like a secret. And most people never actually gave money to Madoff directly. They gave it to middlemen, feeder funds, who pooled everyone's savings and handed it over, taking a healthy fee for the privilege. Those funds were supposed to be the watchdogs. Instead, they were the salesmen. Their fee depended on not asking the question. There's a darker layer too. Madoff often raised money inside communities he belonged to, trust built on a shared background, a shared temple, a shared friend. when the person recommending the investment is someone you love and admire. "Let me independently verify this" starts to feel like an insult. The trust was the weapon, and the trust ran deeper than individuals. Charities kept their endowments with him. University foundations, a Nobel laureate's humanitarian foundation, lost essentially everything it held. For institutions, it was the same seduction in institutional clothing. Steady returns meant budgets you could promise years in advance. When the scheme died, some of those charities closed their doors within weeks. The bucket hadn't just held rich men's yachts. It held scholarship funds and hospital wings, so the smooth line stayed unquestioned, not because people were stupid, but because everything about the design punished the person who checked and rewarded the person who believed. That works beautifully, right up until people want their money back all at once. In the autumn of 2008, the global financial crisis arrived, and it did the one thing a Ponzi scheme cannot survive. It made everybody want their cash at the same time. Between September and December, investors asked Madoff for roughly $7 billion back. And Madoff's bucket, the real one, the bank account, did not have $7 billion in it. It never had. The new money slowed to a trickle just as the old money demanded to leave. There was no strategy to sell, no stocks to cash out, nothing underneath at all. For the first time in decades, the countdown he'd been running finally reached zero. And a man who had fooled Wall Street, the regulators, and half the philanthropic world for a generation ran out of the only thing that had ever been holding it up, other people's money. Which brings us back to that apartment in December, and the sentence, one big lie. The next morning, his sons turned him in. Madoff was arrested on the 11th of December, 2008. He pleaded guilty to 11 federal crimes and did not fight it. On the 29th of June, 2009, a judge sentenced him to 150 years in prison, the maximum, and called his crimes extraordinarily evil. The sentencing told you how completely the mask had come off. Victims stood in that courtroom and described losing homes, retirements, their children's futures. And when the judge invited letters testifying to Madoff's good character, from family, from friends, from anyone at all, the number he received, after a 50-year career at the summit of New York finance, was 0. 17 floors of paperwork and not one page in his defense. The famous number, $65 billion, was itself part of the illusion. That was the total on the fake statements, most of it profit that had never existed. The real whole, the actual savings that real people actually lost, was closer to 18 billion. Even his crime was inflated. In the years since, court-appointed trustees have quietly recovered most of that real money, roughly $14 to $15 billion, much of it clawed back from the winners and returned to the losers. Some victims were made nearly whole. Others lost everything and did not live to see a cent. Bernie Madoff died in prison in April 2021, aged 82. He never really explained why a man already rich and respected chose to build a machine that could only ever end this way. So here's what Madoff actually leaves you with, the reason this is a money villain and not just a sad story. Every great fraud has a tell, and his was hiding in plain sight the whole time, the line that never blinked. Real returns are ugly. They lurch, they hurt, they make you wait. When something promises the reward of risk without the ugliness of it, when the line is too straight, the story too exclusive, the questions too unwelcome, you are not looking at genius. You are looking at someone drawing the line by hand, so carry the checklist. Returns too smooth for their strategy, check. A story that requires an expert you're not permitted to question, check. Vouchers who earn their living from your belief, check. None of these proves fraud alone, but each one is an invitation to count instead of trust. Madoff's investors received that invitation every month for 17 years. The price of declining it was everything. The whole thing could have been undone by one person, one afternoon, and a calculator. The calculator was never the problem. Nobody wanted to be the one holding it. The only thing that kept it alive was that trusting felt so much better than counting. Every fact in this story is on the record. The sources are in the description. I'm Vincent, and this was Money Villains.